JPMorgan raised its forecast for municipal bond sales to $460 billion this year, the majority of which it expects to remain tax-free. As the GOP tax bill continues to work its way through the Senate, what could the incoming shifts to the U.S. tax code mean for muni investors? I want to bring in Sylvia Yeh, Goldman Sachs Asset Management co-head of municipal fixed income. Sylvia, great to have you in studio. Thank you so much.
Thanks for having me.
So it seems like the potential worst-case scenario has been taken off the table in terms of the tax bill's implications for munis. Talk to me about that.
Yep, I mean, to start the year, we definitely had a lot of headline around the muni market. I feel like we get that from time to time with the change in administration. And maybe this time we really thought there was going to be a chance that the tax exemption would be disrupted, nevertheless, potentially removed. So it's been great to finally feel some sense of relief come back to the market, believing that that's off the table. I don't think that means that munis are safe. I think that there will be, just tangential implications with respect to maybe endowment taxes, maybe certain sectors of the market still on the table if the administration is looking for dollars. But the tax exemption in totality as it stands and what we all look for when we're investing in the municipal market seems to be okay for now.
Yeah, and you mentioned that's a removal of a big headwind, but there are also still other potential policy risks on the table for munis. Why is now the right moment for investors to be looking into municipal bonds?
Yeah, and it's nice to actually feel that it's a great time to invest in municipal bonds.
Yeah.
We have a few really nice, tailwinds here, and I think the yield environment, first and foremost, for a really long time, we were in a period where investors weren't really excited about where actual yields were. Why invest? Why not just sit in cash? So to see yields and be in an environment where we're actually seeing nominal yields north of 100 basis points higher than they've been over the last 10 years on average across the curve is pretty exciting. Like, there is meaningful income behind that. And then I would say from a valuation perspective, when you compare it to treasuries, which is a natural for most muni investors, the valuations are saying that the muni market is attractive, like lean in, dip your toe in. And then if we look from a credit profile, which is a real strength that we have in the muni market, credit fundamentals remain strong. And I think that's a really important message. So you have three major boxes ticked. And it's almost like, what else are we waiting for? The time is right.
And since you mentioned it, I am curious about any sort of competition that might occur with U.S. Treasuries. We have some folks who come on and say they still see the 10-year hitting above a 5% yield this year. Yeah. Does that present a headwind to muni bonds in any way? Talk to me about that.
Sure. So I think we're always looking at munis fair value versus treasuries. I think we are looking at taxable muni versus treasuries. I think that there is a preference or a belief that treasuries offer more liquidity versus munis. I think that the current market landscape is actually encouraging us to look beyond traditional fixed income in munis and treasuries and look at corporates, investment grade corporates, right? Yeah. And looking at that pack of four, almost as close as, I guess, a credit profile as you can expect, and looking as to where the value and where the opportunity is across all four of them. Sure. So using Treasury as the base point, even though it's no longer AAA, but using that as our baseline where we want to get started and what we think the value is, excuse me, and what the actual portfolio composition would look like. I think there's going to be opportunity across the board and across those four sectors, just given the uncertainty and the volatility that's going to stay with us through the end of the year.
I was just going to ask you, since you bring it up, the Moodys downgrade, and to what degree that impacts your space, if at all.
Yeah, it's something that we definitely have to pay attention to. It was the last of the rating agencies. I think that, most asset managers have taken that into consideration over the years with the other downgrades that we have seen. It's still the United States of America, so I think we need to take that into consideration. But munis largely are rated AA, AA minus, right, in totality, and we still have about a dozen municipalities that are actually rated AAA.
Yeah.
So not discounting the United States, still strong credit quality. Again, headline noise for some clients who might not be in the weeds and as sophisticated, but not something that I think we're worried about longer term.
And I think one of the other things that I've heard a lot about from some of the folks that I've spoken with has been this concern about state and local government spending, not just, kind of the federal budget, but that state and local government budget. To what degree does that impact how investors should be looking into opportunities within munis?
Yeah, really, really good point. Munis have been in the market for about 26 years now, and we have come a very long way. Do-it-yourself market, too. We should not be doing it ourselves anymore. And largely, the biggest reason for that is going to be the credit quality and the credit profile of all of these munis. Post-financial crisis, when the monolines lost their AAA, it is so important that we're looking under the hood on every single name that we have, and they're not all created equal. what we also need to keep in mind is post-COVID, a lot of these municipalities received a tremendous amount of cash that they've responsibly managed X amount of years later. They're still at high percentages. They're being used, but they're being used sparsely. That, with the revenue streams that they're getting, the diversification of those revenue streams more broadly, they're pretty resilient.
Well, it's interesting. It makes me think too about, for our audience listening who is excited by the resilience that you're talking about, what are those best opportunities where they could potentially get some great returns?
Yeah, there are so many. I mean, there's so many, going back to not doing it yourself, and this is where we get excited because there's so many different ways that you can access the muni market. The same way no two munis are the same, no two clients and their needs and wants are the same either. I think there are traditional mutual funds which will always have a place, especially if you're looking to access parts of the marketplace that you can't kind of do on your own. There, I think about municipal high yield. GHYIX, our municipal bond fund, is doing tremendously well, and really that individual bond selection and sector focus has really allowed that fund to do and provide for clients what it's supposed to do. And then I look at separately managed accounts, which have grown tremendously since the financial crisis because of the transparency and the customization and the personalization that it offers, allowing clients to have their influence in their investments, have really, really grown. So for clients who want that customizations, that's a really great place to be. And then ETFs are the new trend, so you can't not talk about ETFs. And we just launched our suite of muni ETFs at the end of July last year, and we have a really short duration, ultra short duration product, GUMI, which allows us to take advantage of the front end of the curve and help those clients step out of cash and into the market. And then we have our traditional intermediate, GMUB, which allows us to really have beta access to the marketplace. And then piggybacking off of what we do super well, our opportunistic municipal bond fund allows us to really look for those best ideas in mutual fund format. We're bringing that in ETFs with a concentration and focus on two high tax states, California and New York. So we're trying to allow our platform to really evolve to meet the needs and wants of our clients. So it's an exciting time.
Exciting time. Thank you so much for joining us.
Thanks for having me. I appreciate it.